Hey guys, it's Stephen from HDQ Chartered Accountants, and today I just wanted to share some basic concepts around discretionary trusts. So, in our property investment journey and our business building journey, we would have heard about discretionary trusts. We might have heard some terms like asset protection and tax minimization. But how does it all work? So, what a discretionary trust is, it's kind of like a relationship. So it exists to separate legal and beneficial ownership. So what that means is one party can own an asset and another party can reap the economic benefit from that asset. So say for example, we have a discretionary trust that owns a investment property. The legal owner would be the trustee, but then the person who can receive the benefit would be the beneficiary. So the main roles that exist in a trust would be the trustee, which would be the legal owner, which can be both individual or corporate trustee. The best practice is to use a corporate trustee because it's easier to manage and you have the flexibility to change the directors. The beneficiaries are the people who can benefit from the trust. Appointer is the person who has the discretion to change the trustee at any time, so basically ultimate control. And the settler is the person that sets up the trust and it really isn't involved afterwards. So how does the taxation work and how do we reap benefit from this structure? So let's go through an example. So let's say this trust has a corporate trustee called HDQ Trustee, Pty Ltd, and that acts as trustee for the HDQ Family Trust. This trust owns one little property that has no mortgage, that gets about, let's say, $20,000 in net rent after expenses. So corporate trustee is the legal owner on behalf of the trust. The trust receives the $20,000 in net rent after all of the expenses. So what happens at the end of each financial year? What happens is in the trust deed, we would have elected some beneficiaries. So let's say the beneficiary of this trust is Stephen and Stephanie. The directors of the corporate trustee before 30 June can determine the proportion of income that is to be distributed to the beneficiaries. So say for example, if Stephen is already on a tax rate of 34.5%, earning 75K a year, and Stephanie is at home, not working, and her tax rate is currently 0%. What we can do is you can say, hey look, Stephanie's got 18,200 tax-free. Let's distribute 18,200 to her. And let's distribute the remainder to Stephen. This can change year to year because it's a discretionary trust. So say for example, if this was reversed or we wanted to split it in half, we can do 10,000 and 10,000. And then the funds would be distributed to the beneficiaries. They will get assessed at the marginal tax rates and then they ultimately keep the money as well, as that's for their benefit. But the ownership of the property itself is still in the corporate trustee as the legal owner. So what else do we have to consider as property investors? We need to also consider land tax. What state are we going to be investing in? Say for example, Queensland. Queensland has a tax-free threshold for discretionary trust up to 350K. Whereas if we bought an investment property in New South Wales, we have to pay land tax from the first dollar. So it really depends on your situation, whether it's good or bad, whether it's appropriate. But at first, you need to consider, hey look, who are my eligible beneficiaries? What tax rates are they on? Where am I going to be investing? how long I'm going to be investing for, and what's my exit strategy. Because the last thing you want is to buy a investment property, it's negatively geared, you only intend to hold it for 1 or 2 years, and then you're going to sell it, and then there's not too much benefit there. But say for example, if you're a long-term property investor, like most profitable ones are, you're going to invest for 10, 20, 30, 40 years, and then you're going to exit. So along the way, it's going to become positively geared, because the main two expenses of any rental property is one, the cost of borrowing, which is the interest, and the second thing is depreciation. And as you start to pay off your loan, this will inevitably become positive. So lots of things to consider. The people who benefit most from this structure are usually low levels of debt, lots of income to distribute, but if you're just starting out, it could be a good option in the medium to long term. But at the beginning, when you first purchase a property, it's very likely that it could be negative, break even, or even slightly positively geared. So therefore, the tax savings is not going to be as large as if you had 100K of net rent and you had 5 or 6 eligible beneficiaries to split up and distribute that income. So if you would like more information about discretionary trusts, it can get quite complex. Please reach out to us at HDQ Chartered Accountants. I'd also like to mention that beneficiaries, there are also different classes of beneficiaries, and you can also restrict the beneficiaries, say for example, to bloodline descendants. Thank you. Bye.